Good afternoon. I am Tara Olson, Naples, Florida real estate broker, and I am here to discuss the new condo financing rules that just came out August 3rd, actually. What every buyer needs to know. So if you're thinking about buying a condominium, this is one of the most important mortgage updates you will hear this year. As of August 3rd of 2026, Fannie Mae and Freddie Mac have made significant changes to the condominium financing, and these changes affect how lenders review condominium associations before approving a conventional loan. Even if you have excellent credit, a strong income, and plenty of money for a down payment, financing can still be delayed if the condominium project doesn't meet the new requirements. So today, I will explain what changed and why it matters and how you can avoid unnecessary delays. Why this matters: when you purchase a condominium, the lender isn't just approving you, they're also reviewing the condominium association. That means the association's financial health, reserve funds, insurance coverage, and other documentation all become part of the loan approval process. Starting today, that review becomes more detailed for many condominium communities. The biggest takeaway is simple. Start the condominium review as early as possible. Waiting until the last few weeks before closing could create delays that are completely unavoidable. Change number 1. Limited reviews are being eliminated. For years, many condominium projects qualified for what were known as limited reviews through Fannie Mae or streamlined reviews through Freddie Mac. These review methods required less documentation and generally made financing quicker and easier. And as of August 3rd, those review options are being retired. Instead, many condominium projects will now require a full review unless they qualify for another exemption. A full review takes a much closer look at the condominium association, including the financial statements, insurance coverage, reserve funding, budgets, pending litigation, and structural concerns. Because lenders may need additional information from the HOA, buyers should expect the approval process to be longer. And if those documents aren't readily available, that's a problem. And you need to care about basically getting the process going as soon as you can. If you find the perfect condo, the inspection goes well, your financing appears to be on track, then your lender requests additional documents from the condominium association. If the HOA or management company is slow to respond to your closing, you definitely can develop some issues and it'll be delayed, and you don't want to go there, even if you've done everything right. That's why beginning the condo review early is more important than ever. Change number 2, good news for some condo communities. Not every change makes financing more difficult. One positive update removes the previous 50% investor concentration or owner occupancy limitation for many established condominium projects. In simple terms, some communities that previously had too many rental or investor-owned units to qualify for a conventional financing may now be eligible. This could create new financing opportunities for buyers interested in communities with a higher percentage of investment properties. Keep in mind that new construction condominium projects still have different financing requirements. Change number 3, stronger reserve fund requirements, another significant reserve funding. Reserve funds are essentially the condominiums association savings account for future repairs and maintenance. These funds pay for things like roof replacements, elevators, parking lots, exterior painting, structural repairs, and other major improvements. As of August 3rd, again, if a condominium association uses a reserve study, it generally must budget for the highest recommended reserve amount identified in that study. The previous baseline funding method will no longer satisfy the new agency requirements. The goal is to encourage stronger financial planning and healthier condominium associations. Another important change coming in 2027, these updates don't stop here. Beginning January 4th, 2027, many condominium associations will need to increase their minimum replacement reserve funding from 10% to 15% of their annual budget assessment income. This is another step towards improving the long-term financial stability of the condominium communities and reducing the likelihood of unexpected special assessments. What buyers should do. If you're thinking about purchasing a condo, here are 5 simple recommendations. Get pre-approved before you start shopping. choose a lender that has experience with condo financing. Have your lender begin reviewing the condo project as soon as possible, and be prepared for additional documentation from the HOA. Don't assume every condominium qualifies for conventional financing. Starting early can save you time, reduce stress, and help prevent last-minute surprises. My final thoughts: condominium financing has always been different from financing a single-family home, and these new agency guidelines make choosing the right condo and the right team even more important. The good news is that most financing issues can be identified early with proper planning. Whether you're buying your first condo, a vacation home, or an investment property, understanding these changes can help you avoid unnecessary delays and move into your new home with confidence. So if you're considering buying a condominium in Southwest Florida and have questions about financing, reserve studies, HOA docs, or whether a specific community may qualify for conventional financing, I'd be happy to help. You can give me a call at 239-357-7499. And if you found this video helpful, please like, subscribe, and share it with anyone who's thinking about buying a condominium. And I will see you in my next video. Thanks for watching.